Out of every single markup that I've done on this, my third YouTube channel, I think this one is by far the best I've done that highlights the algorithm of trading. I'm not even gonna remove some of these, even though the move has, gone through as I clearly pointed out. But rather, I'm going to just show you guys. So this is a tutorial recap review. So even though I'm gonna elaborate on the next potential move, I have to show you guys this because these past movements are what's going to help prepare you guys for future movements. So sellers entered at current month high. We got that. We saw the wipeout that took place. 1, 2, 3 price drop model. I'll leave the links earlier tutorial in the description below. We saw the model that set up for the traders to, buy into this move, and they went right back up into the zone that sellers are still present. And we saw the subsequent drop. What a drop it was. So every single person that was on the previous move got taken out. Now those who sold into this era, let me go full screen. Those who sold into this era, their stop losses are above here. So SL, SL, their stop losses were above there. Now work with me now, work with me. We had a market gap, and in Forex, market gaps are one of the target areas in Forex. The next one being wicks and price ranges. The thing about gaps are they have to be filled. So this is a strong distribution. This is a transactional move. The distribution is the last phase of the AMD model. It's when the price goes off in the intended direction after the liquidity sweep. The liquidity sweep is the manipulation. So right around here where market price was going back up into the zone where sellers are present, this area is the A area, accumulation. The area where the market price seemingly was showing a buy off to get traders to buy into this move. That way upon buying here, their stop losses would have been down here. So this is the manipulation. And then the true move, once the market maker has identified that persons bought into this area and their stop losses were down here. Yeah, so let me just do this quickly. As I said, this is a recap. B, that's the buyers. Down here, so these guys, their stop losses got ran. So this move resulted in their stop losses got ran. Now the market maker understand that their head is in a tizzy right now. So they went and chased the price and they did what? They sold at the bottom. I'm not going to label that out. Yeah, they sold down here. So he shot back the price back up, which resulted in a market gap. Because two things happened. Not only did he knock out all of those who sold at the bottom by shooting back at the price, he also went and took out those who were at break even here. Because this paid a lot of persons. A lot of guys who traded the Dow Jones got paid on this move. Probably even bought a car. Now, this now is me showing you guys the attempt at recovery. So let me get this here. So buyers bought into this area, but their stops would have been in this zone. So I put a couple B's here on the earlier tutorial. Yeah, so a lot of persons bought into this. So the first wave always gets stop hunted. The first wave, the wave that gives us the initial structural high. Notice I said I place the word crown right here. So knowing this, the market maker sent the price back down, but the floor was still respected. Not broken. So that was the first clue to us that buyers are present in discount zone. So this is all of this move gave us a discount, so buyers are still present. But not because buyers are still present, that doesn't mean that the order block from up here has been broken. So first attempt, bam. Notice the labeling here. Sellers are still present. So the price went right back into the same zone. Yes. This is where labeling a chart comes into play. The market price went right back, people, into the same zone where we had this 1, 2, 3 price drop model. And as such, it couldn't break past it. He went right back up into this. So look here. This, whenever you see these, you have to label them, mark them, put a note, something that is going to remind you of what the price is going back into. So with that being said, okay, and earlier I said price has to stay above this line. Now, what happens when price does not stay above this line? Here was your first clue. Price dropped back down, wiped out all of these guys on this first wave. This would have been the recovery attempt, but as you can see, it fell short. So I'm gonna call it the simple term lower high, LH. Now price re-break. Remember, the line still valid in terms of your analysis, but because it's a constant reminder, price has to break and stay above this line. That didn't happen. Now look what happened. This is why I say you can't follow patterns in Forex. Notice where price came here. Notice upon the next drop where market price came here, significantly lower. This completely blows out of the water the notion that, oh, look for higher lows, higher lows. No, because this is a LL, lowest low, higher low, and this is what? This is lower than here. Let me circle it. I know many persons might have disagreed with me. This right here so is lower than here. So at this point, question mark. What's going on? Because this went lower. But you should pay attention. Low, respected, and was not broken. That was the first biggest thing. So these type of things cause it to, well, cause younger traders to be tripped up. More sophisticated forex traders who have been studying these moves and reviewing these moves, especially on the weekend, preparing for the next trading week, they are more prepared. So now price has given us a double buy rejection, but also price has given us a double what? Low price respected zone. So we got two discount attempts. So this was a discount move, and buyers got what we call how do I say, a third wave. But this was right the first, second, third. All right. So the first wave with the gap area, second wave, and this is the third wave. And the third one worked the charm. He couldn't break past the area, so he sent the price a little bit lower, just a tad bit lower to get what he needed. And then we saw what happened. The reason why I'm doing this, the reason why I'm recapping this, I don't want when persons see a move like this, especially if you've been watching my videos. It makes no sense I share this knowledge and people still not getting it. The reason I'm doing this, I wanted to show that it's not all the time a market price is going to take off. Sometimes, given the severity, or should I say the strength of the order block that resulted in the strong move, the recovery attempt to send back the trend in its buying direction ain't gonna be some walk in the park, as you guys can clearly see with the Dow Jones Industrial right now. Now, this time, he got what he needed. Price went stayed above the zone. Notice how price reacted around this area. Not to brag, but if I was at the chart at the time when this happened, it would have been the cleanest entry. So everybody even bought here. Those who got it down here got it the best, but I know a lot of them miss. But anybody who even bought here, provided they had labeled their chart accurately, they're good to go. Price then took out. So all these sellers now, every single person, come on, let me shift cross. Every single person that sold over here and their stops were anywhere in this vicinity, they're gone. This big candlestick ran their stops. And naturally, those who bought here are in trouble. Which brings us to where we are right now. For every single strong move upwards, strong impulsive move in Forex, not only do you have to be mindful of where the market price stops in terms of buying and selling high and low of the day, you also have to mark it and you have to determine whether the next subsequent move is going to be just a slight little retracement or a complete wipeout. So I often tell my students, do the basics. Look for the equilibrium area on every single solitary swing move, up or down. And once you find that equilibrium zone, so for me, let me just, where's the ruler? I think I had the ruler earlier. All right, let me just use the Fibonacci quickly in the interim of time, just to show you guys. So this is the distribution. So oh wow, see, you don't even need it. Yeah, delete. So right around here is the equilibrium, 50. right? So market price now can in fact pull back. A break below this line right here, so it's going to indicate stronger selling. All right. But if market price comes into this zone, into the equilibrium here, I'm not going to make this too big, and stays above equilibrium upon the pullback that we're looking, I'm anticipating a market pullback. From it stays above the equilibrium zone and then starts to make the recovery attempt, we're looking for more buying. So, bam, green. I'll give it a different color. Let's give it blue. Light blue. Buying continues. It's simple basics. Simple solitary basics. So I can look at right here, so a pullback zone, and then those who bought on this is a potential area for market maker to run some stops. So I'm going to highlight this zone for you guys. I'm really giving you guys some gems today, not sure. The reason why this is a strong pullback zone is because buyers entered here, B. And because buyers entered here, their stop losses are in this vicinity. So it's a wonderful time for the market maker to then say, okay, I'm going to run these stops before I then proceed to send the market price back up. So freehand marker, rain is falling. A potential run the stops might go below, but as long as we stay above, should see a correction. All right, raining look harder right now, so I'm gonna wrap up this video. Hope you guys enjoy this recap. Peace.